So, ladies and gentlemen, we try to start our last session and the pre-last panel. We will have 2 consecutive panels as after the lunch. As a matter of fact, we already started the discussion, so now you can connect in the middle of our discussion. We started at exactly 3:45 because that was the advertised timing. But so far it was really very vivid and interesting, and I hope that the panelists will keep it as vivid as so far. Our panelist has a very interesting feature in comparing with the previous panels. None of them has anything to do or has had at any time in his life to do with the IMF or the World Bank. So they are central bankers who only visited the IMF or the World Bank, but never worked for them. But all of them are kind of central bankers and this kind of scholars. Stephen Cecchetti is actually the chief economic advisor at the BIS. Professor Goodhart, I think I shouldn't introduce. He was the advisor of the Bank of England and the professor at various universities in London and all over the world. And Cristian Popa, who has been the deputy governor of the Romanian Central Bank in the past 15 years. You started your third 5-year, yeah, Cristian, and lecturer in several universities as well. Almost all the 3 panelists have something to do with the BCBS, so they have some microprudential and macroprudential feeling as well. As a matter of fact, our topic is very narrow: macroprudential policy and monetary policy. Nothing easier to reply how to coordinate. Macroprudential policy seems to be a brand new term. The first time it appeared, of course, in the BIS papers in 1974, as we know, but before the crisis, we didn't use this term. We concentrated on the individual banks and individual institutions of financial intermediaries. Macroprudential policy means something that will look at the whole system, which can generate endogenous shocks in itself and may have influence on the real economy. It means that the financial sector is neither frictionless nor exogenous to the real sector. For central banks, it means that so far we had a trade-off between growth and price stability. We focused on the price stability, but was always accused, why don't we pay more attention to the second part of the famous Taylor rule, to the output gap? Now we face a 3-sided trilemma, not only dilemma. And the third side is the financial stability. The big questions we would like to answer in this panel during the coming 60 minutes. Which one should dominate the other? Is it a right perspective at all that one of the monetary policy or the macroprudential policy should be the dominant part? Second, what does it mean and how should we evaluate the leaning against the wind? What is the right answer on the famous question, 2 targets with one instrument, or 2 targets, 2 instruments? From the previous literature, we know that there is a distinct line border between Professor Cecchetti and Professor Goodhart. How much should be the monetary policy involve macroprudential policy? And the third question, that what is the right role of the central bank as an institution? Should it be solely responsible for macroprudential policy, or should it distribute the task with other institutions, that is government and local supervisors. So that will be the first circle. I would propose to start from my right to the farthest right, and we agreed that none of the panelists will show any slides, though Professor Cecchetti has a lot of, and if you will ask, he will show you. But now at the beginning, each will take 10 minutes and summarize his standpoint on this very important issue. Stephen.
Well, thank you, Julia, and let me also thank the National Bank of Poland for their very kind invitation to participate in this conference, and also thank them for including me in this panel to discuss macroprudential policy. The first mention of the term macroprudential, actually, I found in a document at the BIS was from the Cross report, which is 30 years ago. It's report number 1 of the Euro Currency Standing Committee, which is the precursor to the Committee on the Global Financial System. And it's pretty interesting. You can download this if you want from the website. It's been scanned. But the first chapter actually, it's basically about some other things. But the first chapter, I think, foreshadows a lot of the problems that we saw and that we faced in the last 4 years. I think that with that as a sort of etymological introduction, let me say that in terms of economic and financial policy, I believe that we need to change the way that we think about things, and we need to change the way that we act. And I think that this is true both for the private sector and for the public sector. Thinking about it from the point of view of policymaking, there are these 3 things that we try and deliver as policymakers. Try to deliver high growth and employment. Try to deliver and that's a sort of trend growth structural issue. The second thing is stability in prices and in growth. And the third thing now that we add to this that we didn't think about enough before, at least not enough for me, is financial stability, which is to try and make crises less frequent and less severe. Now, if I go back, I'd like to divide the rest of my comments into talking about sort of the discussion of macroprudential policy and monetary policy is one really in thinking about sort of the needs for coordination or the needs for different kinds of governance structures. So it's useful always, I think, to go back and think about what things were like before the crisis, which isn't that long ago, so I can remember them. Now, the pre-crisis consensus and the assignment of objectives and tools, if we think about those 3 things that I talked about a minute ago, were that growth and economic structure was the purview of fiscal authorities. Tax and expenditure policies were designed to try and deliver high long-run growth and also determine how it is that the output in a society would be divided up among its various among the various places where it ultimately went, depending on the tastes or the desires of the society for government services versus investment and consumption. Price and output stability was the purview of monetary policy, which used interest rates in order to try interest rate instruments or possibly other instruments in smaller countries associated with exchange rates to try and deliver low and stable inflation and high and stable growth. Coordination here, I think, was pretty straightforward. One of them was long-term, one of them was shorter-term. Fiscal policymakers generally acted first, and monetary policymakers acted at a higher frequency and acted second. Now, we also at the time had and still have microprudential regulation, which was designed to limit individual institutional failure and also to try and control the risk-taking that arose from moral hazard that was created by some combination of deposit insurance and limited liability that banks faced. Now, if we think, so that's sort of the pre-crisis lay of the land. If we look at the post-crisis world, first of all, the objectives have changed a bit. On fiscal on fiscal policy, I would say that we now really have to maintain sustainability. That was the discussion of the previous panel, and I think also in the previous panel there was the immediate implication of the need for buffers that exist in the case of should catastrophe hit, either man-made or natural disasters could hit an economy. And so I think that when Carlo Cottarelli mentioned the need to keep 40% debt to GDP ratios, this is sort of leaves you enough space that during some periods you might have to rise higher, but then you bring it back down slowly. On monetary policy, we also have to address the buildup of imbalances that can arise even when inflation is low. And on regulatory policy, we have to confront the buildup of systemic risk, and that's the macroprudential dimension. Now, in thinking about macroprudential regulation, and I'll bring this back in a minute, but it's I think important to make sure that we understand. I always like to go back and say, if I'm going to have a government intervention, I have to find an externality that justifies that government intervention. The externality, there are two externalities in this case. The first one is associated with the cross-sectional dimension, the sort of more timeless case, and that is the common exposures and interlinkages that exist in a financial system where an individual institution's actions, the costs of those actions are not necessarily borne by that institution should something go wrong. The second one is pro-cyclicality and fire sales, or just procyclicality, and that's the time series dimension. Now we're trying right now to fashion tools to address these, to force institutions to face these externalities, the costs that they're imposing on other people. In the cross-sectional dimension, more capital, more liquidity, a leverage ratio, and limits on activities, some combination of those things. Microprudential regulation on steroids, if you will. That's kind of what we're doing, and it seems to me that that's the right thing. For the procyclicality case, we're trying to discuss time-varying policies associated with capital buffers, dynamic provisioning, haircuts and margining practices, time variation in risk weights, loan-to-value ratios, and the like. I should mention, because it came up this morning, that the decision to have zero risk weights on sovereigns is a local regulatory decision. It's not a decision that's embodied somehow in the standards that are set at the level of the Basel Committee, and it's also it is not in Basel II, actually. It was in Basel I. Yeah, it is not in Basel II, and it's certainly not in Basel III. And it's also the case that that the banks, in terms of their internal risk management, one would hope that they would have behaved themselves a little bit better. Now, the question that I think we need to ask is whether we can maintain the pre-crisis division of labor and governance that we had. And here on macro, I would like to think about the interactions. On macroprudential policy and fiscal policy, time-varying risk weights and loan-to-value ratios and things like that look an awful lot like tax policy to me. So it looks like there's an interaction there. On macroprudential regulation and monetary policy, if you think about changing capital requirements in a cyclical way, what you're doing is you're affecting the cost of lending, which is a lot like what happens when you change interest rates. Now, which brings up the other question, is the interest rate a macroprudential tool? Or is time-varying capital requirements a stabilization tool? Now, I think it's a challenge that we have to think about. Who does what and when do they do it? Can we set up a governance structure that allows appropriate actions with the appropriate accountability that we need? And I'll close by saying that it took us a half a century to get to the pre-crisis consensus on fiscal and monetary policy. So I don't think that we should expect that we should know tomorrow, or much less today, what the right structure should be. Instead, what we should do is we should set up a system that's sufficiently flexible that can adjust as we learn how to do these things, with the knowledge that we're likely to get it wrong at first, but that we need to be sufficiently able to watch and to learn and to change. And I'll stop there. Thank you.
Perfect. Professor Goodhart?
Thank you very much, and thank you to the organizers. I think it was this morning when President Trichet said, this is not the time to be complacent. I'm always waiting for a central bank governor to get up and say, now is the time to be complacent. I've waited many, many, many years, and in order to try and overcome this particular barrier, I'm going to say that this particular problem we are facing in this panel, the problems of coordination between monetary policy and macroprudential policy, is a subject upon which we can be complacent because it's very easy to handle. It's not a serious problem. Considering the problems that we were discussing this morning, the problems, for example, of how do you restructure Greece and what should be the private sector involvement, problem of how do you recapitalize the banks, who does it, how much, the problems of how you ring-fence some of the weaker sovereigns, the problem that was particularly mentioned this morning on who does the adjustment, the fundamental adjustment within the EU, and who bears the burden. Now, these are intractable problems, as we've already discovered, and as we will go on having summit after summit after summit on them. Now, this particular problem is actually quite easy. It's possible, and here I'm going to coin a completely new original term. One can actually devise a separation principle. Now, there are a number of areas where you say there may be conflict. One of them, of course, is the fact that any of the actions to undertake monetary policy, or indeed to do macroprudential policy, may involve operations on the balance sheet of the central bank itself. Now, might this not cause a conflict between the operations that the monetary policy people want to make and the operations that the macroprudential people want to make? My answer to that one is no, because under my separation principle, what really matters for the monetary policy people is what is the quantum, the total amount of the central bank's assets and the monetary base that they actually thereby generate. And indeed, if you've got interest rates at zero, the total quantum of the quantitative easing that they may undertake. And that is a monetary policy matter. But when it comes to the composition of the central bank assets, it actually doesn't matter that much. It has the same effect on monetary base, it has the same effect on quantitative easing and getting them, the money supply out there, whether you buy public sector debt or private sector debt or even foreign debt. So when it comes to the question of macroprudential, what that really means in terms of the operations of the central bank is actually buying various kinds of private sector debt or lending certain loans to private sector, emergency lending, for example, or credit easing, a la Ben Bernanke. So when it comes to actually shifting the composition of the central bank debt, and particularly of operations in private sector debt, that is undoubtedly a macroprudential. When it comes to the aggregate quantity of the operations and the total size of the central bank's balance sheets, that is monetary policy. And so there's a very clear, in my view, separation principle, and it's quite easy to maintain. Now, Steve has mentioned, and of course it is absolutely correct, that interest rate policy varies the cost of borrowing. Indeed it does. And such things as changing liquidity requirements, changing capital ratios and all that also changes the cost of borrowing. Doesn't that mean that there's a conflict? And again, I would say that the degree of conflict is vastly exaggerated and relatively minor, because the purpose of the macroprudential instruments is that they're much more focused. Interest rates are absolutely across the board. It's what's known as a blunt instrument. It affects everything. If you're dealing macroprudential, You're being, or you should be, much more granular and much more focused. What's more, it's not even clear what the necessary direction of the change in interest rates is when you undertake your macroprudential activities. In normal cases, if you want to tighten and you toughen up in capital requirements or you toughen up in liquidity ratios, it tends to raise interest rates. That's true. But think what happens if you actually tighten up by making your loan-to-value ratio or your loan-to-income ratios much tougher. That means that you're actually cutting off or trying to cut off some borrowers from being able to borrow. That actually would tend, other things being equal, to lower the interest rate. So although it is true that macroprudential instruments will affect interest rates, they don't affect them at all in the same way. And it is a much more focused purpose of using macroprudential. Again, the ECB, for example, will change the interest rate level for the Eurozone as a whole. Fine. But when you come to macroprudential, what you're trying to do is affect the housing market in, shall we say, Spain. And to do that, you are affecting sort of various kinds of instruments which will affect a market in a country. So again, it's much, much more granular. The two are not the same. The two are clearly different in many ways, and the two can be handled side by side, in my view, without any real difficulty at all. I will end by saying that, in fact, the appropriate use of macroprudential instruments could actually ease, simplify, and improve the conduct of monetary policy. Because without the proper application of macroprudential instruments, we are left with one instrument, which is the official interest rates, and two potential objectives: price stability and inflation targets on the one hand, and financial stability and asset prices on the other. And we get, as I know very well, having looked at the sort of Swedish monetary policies over the last few years, sort of extreme arguments between those who say that monetary policy should only be used for price stability and aggregate stability, and those who say that you ought to lean against the wind to a degree. Now, if you can actually use these macroprudential instruments on a much more focused way to lean against potentially unsustainable asset price bubbles, that frees up monetary policy to focus where it should be focusing. It was Steve himself who wrote a paper arguing in favor of leaning against the wind, and that has complicated monetary policy. If we get the macroprudential instruments which I want, we can free up monetary policy from having to worry about the earlier problems that Steve himself so emphasized. So I see this, the case of coordination between monetary policy and macroprudential policies, as really a non-problem. You know, sooner we get these proper macroprudential instruments, the better. As I said before, this is a problem which we should be extremely complacent. Thank you.
Thanks. I think it's a quite clear stance. Cristian, before we go to the debate.
Thank you, Julia, and thank you to the National Bank of Poland for having invited me to this conference. I'm given a more difficult task than meets the eye because initially my tactical, let's say, positioning would be to sort of do a summary of both. I find I agree and I disagree in equal measure with the messages. As the bon mot would have it, I used to be indecisive, but now I'm not so sure. It would seem to me that we have a strong case, and Charles was eloquent in pointing this out, that there is considerable synergy and indeed overlap between price stability undertaken by monetary policy and financial stability, and I do use that rather than the macroprudential kind of remit we were given in the panel title. I think it's fairly obvious, but I will point it out nonetheless. Thinking of monetary policy transmission as happening through a black box is neither entertaining nor accurate. We have to look at actually what happens there, and it has been many a commentator which has pointed out that one of the things we seem to know less about now than prior to the crisis is exactly how the linkages between the financial sector and the real economy sort of work and develop over time in all their complexity. It's again a fairly straightforward case to make that financial stability being provided, you will have probably better and more effectively anchored expectations and an easier job of separating signal from noise in terms of transmitting monetary policy. It's also the case, and it has been, I will refer to that more broadly in a short while, that identifying through careful monitoring imbalances that will reflect in financial sector stability negatively can either undermine the transmission of monetary policy signals, or if they tend to unwind in a disorderly manner, they can compromise not just price stability, but potential growth and the general macroeconomic balance of an economy or a number of economies. That being said, okay, the overlap, let's put it this way, hopefully we've established that there's some. It's not, despite what Charles has just been saying, that easy a case to go from recognizing there's synergy between the two to actually implementing it. Why? Let's take a number of difficulties. One is, and it's been pointed out more recently by Ben Bernanke, that the time horizon for monetary policy is taken to be normally the medium run, whereas financial stability has a broader horizon. It can normally not mean there's a problem there. They're both usually counter-cyclical. However, when you talk about different business cycle phases, especially at turns, or indeed, as we now hear, in the trough itself, the consistency is a bit different. I refer here more specifically to this interesting but definitely controversial proposition that since you can infer there are risks to financial stability by the real sector not performing well because growth is depressed for a number of years and looks like it's going to be depressed for a number of years, there is potential in relaxing prudential standards to get institutions to lend more. I think this is extremely loaded. I think that what you could end up is not necessarily a pickup in lending, but further fears for the markets that solvency and liquidity may be undermined for institutions that had controversial levels to start with. Let me not go down that route too far. The second problem is the division of labor. It has been mentioned here by both of my co-panelists. It's difficult to really understand if you have both functions in the bank, in the central bank, who gets to handle which part of the toolkit. And one example is not just interest rates, which can be, let's say, more or less, despite their effect on financial stability, be assigned as a monetary policy tool. It's liquidity provision. And I'm not talking about emergency liquidity assistance. So liquidity provision as such, we have used it as a very effective tool, and we're not the only ones. Indeed, this is not an innovation. This is a recognition right now that it belongs equally to both camps. But if you go via the route of one target, one instrument, you'll pretty soon run out of instruments, which is a conundrum in itself. The other one is something we haven't explored here, which is the traction of both monetary policy seeking price stability and financial stability as an objective of its own, melding together with that of price stability. And that is traction both in the sense of substantial, significant activity, financial sector activity cross-border in many economies. Many, especially new member states, are small open economies subject to this cross-border provision to a significant degree. Like Wi-Fi networks, monetary policy and financial stability do not and probably should not stop at the border. But then there's a problem of how you coordinate internationally. We have some progress there. It remains to be seen how that is built upon with the creation of the SRB. But I think that a lot more of what is being done right now needs to be conducted not just at the EU level, which is probably ambitious enough, but indeed at broader levels, G20 or perhaps larger. Otherwise, the delocalization threat and the distortion of, for example, pricing of financial services may be indeed quite large. There's another glitch in the sense that even if you do concentrate, as it seems to be a building consensus right now, all of regulation, supervision, and assign tasks for financial stability to the central bank, you may be solving one problem which is crucial for financial stability, the requirement for whomever monitors and seeks remedial action in financial stability to be independent. We really do not have setups in which other institutions than central banks can be set up with a full guarantee of independence very fast, and there's also a financing problem right there. But even if it is the central bank, you wonder what the capacity is, and if it's not really distinct between the traction of regulatory, supervisory, and financial stability, or i.e. macroprudential control, together with microprudential control over the banking sector, and the traction over the shadow banking sector of other institutions whose mobility may be even greater. I think that my conclusion would be the fact that we shouldn't think of these as completely separate objectives. That was quite clear from the two previous speakers. I would think that they have different remits, but they overlap to a significant degree. There's a prerequisite, I would say, in both senses, but possibly we should easier think of financial stability preordaining price stability if it's effective. It catalyzes and conditions it. And let me give you the example I was alluding to before. Romania went through, similarly to other new member states, a period of extremely rapid boom before the crisis, about 2004 to 2008. This was manifest in an overheating of the economy. Credit extension via parent-daughter bank lending was a large part, but not the only part of this explanation. And most of it was done in foreign exchange. Obviously, we had an overheating problem. We had a problem of worsening macroeconomic balance, especially in what concerns the current account deficit. You couldn't have very low interest rates because, of course, of Toshowski dilemma concerns. You had a process of intermediation growing quite rapidly in domestic currency, but it was limited by the amount of domestic savings. So with that, we needed to do something else to just make monetary policy implementation less slippery. And we started with reserve requirements. They were differentiated. They were much higher in foreign exchange. They were double the level of those on liabilities in domestic currency. They had no cutoff in terms of maturity, so no evergreening was possible as a loophole. We then went to other instruments which at the time was considered controversial. We went to exposure limits to unhedged borrowers in terms of the aggregate banking sector. We went to LTV and DTI caps, for example. And finally, we went to actual request of higher capital to be provided for those banks whose loan-to-deposit ratios in Forex had jumped the gun in terms of the industry average and who therefore had a higher risk of slipping under regulatory minima. I think this was all good. The lesson I would draw from it was that it was not enough because we were pushing on the host country side and on the debtor side. You need a lot more cooperation between home and host countries, and you need a lot more cooperation and actual implementation from the parent bank, which was not available at the time. So my conclusion to really stop here is that we should indeed pursue simultaneously both monetary policy and financial stability. There's almost no chance to find whether there is a counterfactual, but the actual implementation is a work in progress. And I think we need to, again, referring to Steve's remarks, figure this out as we go along. Thank you.
Thanks for all of you. I think we will run a second turn because we have still time. I see there is clear contradiction and there are some questions which emerge. First, the BIS, together with Professor Borio and Stephen, is a clear advocate for incorporating the macroprudential policy within the monetary policy, within the central bank. The question, whether is it really achievable in a short time and whether is it do we really wish it, will we not lose the independence of the central bank? If I remember the first part of this day, in the first 1 hour, there was not a word about financial stability and about macroprudential policies, though several central bankers addressed to the public. Was it by chance? Can it be gone through? Or it's the right direction try to keep the independent central bank who is responsible for price stability, and let's give the very important role of macroprudential policy to someone else. Since sometimes these two policies not necessarily supplement or help support each other, but contradict. And we should react on these situations. So my questions to the panel, should we incorporate? Wouldn't we lose the independence? And if it's two separate policy, why should the central bank be responsible for macroprudential policy? I expect you to react on each other as well.
I think that's an excellent question. Let me start with a couple of very quick points on which I think I agree completely. Charles and I actually probably in the end agree more than it seemed, but that's okay because we're here to put on a show. But let me say that I certainly agree that that macroprudential policy has to be more focused and more granular, and also, as Chris said, it can't stop at the border. But these create enormous political problems that bring us back to the point to the question that you're asking about who should have this responsibility. So just to be clear about what's going on, I mean, there are these famous sort of very trite lines about the role of the central bank being to take the punch bowl away when the party's getting started. The problem with macroprudential policy is that you're taking the punch bowl away from only part of the party. And those people are going to get angry. And to put a more fine point on it, if you think about trying to stop a housing boom, what you're doing is you're telling people who think they're getting rich that they're not entitled to be rich. This is going to be a very, very difficult thing to do. And I mean, you know, of course we know better. They're not supposed to be rich. They just think they're getting rich, and it's really going to cause them problems down the road, or at least so we claim. Now, how is it that we're going to structure the governance of an institution that is not only going to do this to these people, but also then successfully deliver this message? And I think that this is a serious problem, and one that I don't have a great solution to. I think that the only institution, as Chris said, the only institution that we have that is sufficiently independent to deliver such a message right now is the central bank. But if you do have the central bank start to deliver messages like this, as I like to think about it, every central bank is exactly one parliamentary vote away from losing its independence. In some countries a little bit differently, but in most, I mean, I'll tell you, the country I come from, I grant the US Congress is very bad at actually doing anything, but it is one vote away from the Federal Reserve losing the independence that it has. And so you do have to be, I think, very, very careful with these things.
Well, I agree with Steve almost entirely. And the problem with macroprudential is that it only really bites in the upswing, in the boom. In the downturn, in the panic, in the crisis, it's the market that provides the constraint, not the regulators. And trying to introduce regulation, as Steve said, to make people who think they're getting richer not able to buy houses is going to be quite extraordinarily unpopular. And my concern about macroprudential instruments is that they won't, in effect, be used. And I've been putting forward proposals for what I describe as presumptive indicators, whereby a central bank which has macroprudential responsibility ought to put before the legislature an indication of which 3 or 4 indicators ex ante it thinks are most important as giving a guide to unsustainability. And when those indicators are flashing red, or at least a proportion of those indicators are flashing red, then the central bank governor, or the head of the macroprudential authority, ought either to take action or to write a letter in public to the legislation saying why it thinks that the fact that credit is growing at 45% and housing prices are doubling every 2 years is not a matter of concern. I think that that will change the default, sort of the inertial activity into doing something rather than not doing something. And that, I think, is a major problem, that we won't actually ever use the powers, macroprudential powers that we're given. As to why it should be in the central bank, I think that the answers are fairly clear, that the provision of liquidity to institutions under difficulty is a clear and key element in macroprudential instruments, and really only the central bank can do that. And therefore I think that it really has got to be the central bank. And also the central bank, macroprudential by definition is macro. It's relationship between markets, relationship between intermediaries. And that is macroeconomics. And your microeconomic institutions are basically a load of wonderful accountants and wonderful lawyers who worry about Mrs. X having been ripped off by her bank because they're charging her too much. Now, these guys are splendid, but they know absolutely next to nothing about systemic risk and macroeconomic interactions. And that's what a central bank is actually there for. Now, yes, this is likely to put you at some greater risk of losing your independence. But again, as Steve said, you're one vote away from losing your independence anyhow. And I think that people simply don't realize how much the independence of the central bank in achieving monetary policy owes to the fact that in the 80s and the 90s, most of our developed economies got our debt ratios under control. People talk about intervening in private markets as being quasi-fiscal. Setting interest rates and intervening in public sector debt markets is wholly fiscal. And when your debt ratio is rising and very high, as it was in my country, for example, in the 50s and 60s, the interaction between interest rates, growth, and sustainability is crucial. Absolutely crucial, and it's crucial fiscally. And the interaction between fiscal policy and monetary policy, which in a sense we thought we could get away from because we had our debt ratios under control, we can't get away from under the kind of conditions we look like being in over the next 10 to 20 years. So even if we didn't put macroprudential with the central bank, the independence of the central bank is likely to get under increasing threat anyhow.
Yes, I agree with both takes. We have to, let's put it this way. One thing I don't agree with is the fact that you could become unpopular. I think that that's what central banks are for. If there's not a lot of difference between calling unsustainability on a boom or a phase of the business cycle and doing it in terms of more granular structures. It just affects people in a less abstract manner in the second case. So I think that instead of being evaluated for not having acted, I'd rather commit the sin, if you will, of having acted and have to decide then whether it was forceful enough and whether slippages because of the international dimension, the cross-border dimension, did not occur. I'm very glad Charles raised the interaction with fiscal policy because indeed we didn't spend any time on it. But there's a problem of time consistency as well. And it can become important when you have to deal with different institutions. I don't necessarily think I have the solution, but because the independence of the central bank is something that has been fairly well established for the past 20-something years, you can build upon that. Even within the institution, and here again I agree with Charles, you have a big degree of difference in language and mental representations between the supervision departments and typically the monetary policy and macroeconomic departments. The language is different. Everybody, I think, who's worked in central banks knows this. But that can be improved over time. And that's why we have separate committees, and I think they should stay separate. There should be a degree of overlap, probably through staff representation there, but they should essentially have different business lines to deal with. Again, some scope to do this is out there. If the construction runs in parallel in similar ways, that can actually be beneficial in an international perspective.
So much. I think we have still some minutes to give floor to the public, and Jacob, you had mentioned another one. Microphones? To the first row, please. Jacob Frankel. Okay, 1, 2, 3, yeah. Okay, Jacob. And we accumulate the questions and then the answers.
Thank you. In fact, my remarks were already anticipated in this discussion, so I'll just add a footnote. I perfectly support the idea that the responsibility for macroprudential should rest within the central bank for the reasons that were mentioned, the provision of liquidity and the like. But I would also note that there is a corollary to it. For the central bank to be effective in carrying out its macroprudential responsibilities within the rubric of financial stability, it needs to have the detailed information on the financial sector, and not by virtue of a favor of sharing information received by those who have the right, but having the official right to get the information. So in my book, it means that bank supervision is also supposed to be in the central bank for the very same reason and the same rationale. It's not a matter of empire building, but it's a matter of the fact that there is close interdependence between ability to assess situation and need to have the tools to implement upon it. As far as independence and not independence, I think that the structure of the bank, the structure of the law, and the tradition are those that are designed to maintain the independence. If a policy action is going to be influenced by these considerations, then we are doomed. In fact, my experience, and I think that historical experience, shows that if you are viewed as sticking by your goals, implementing them in an efficient way and in a consistent way, that's the best assurance for creating public support for it that will make the removal of the independence even more difficult. So I think that the difference, a central bank is not running for office. A central bank is securing that the others who run for office have an office to run for. Thank you.
David Marsh. I've got one point and one question. The point is just to challenge this idea that central banks are indeed just one heartbeat away from losing their independence. That might be the case in Hungary, but look at the ECB. It's actually 27 votes away, which is quite a number of votes. And the point about the ECB, I think that the ECB has been monumentally complacent. And Mr. Trichet could easily have become a lot less popular by being more outspoken about the asset bubbles that were building up throughout the EMU area in the early years. I remember asking Jean-Claude Trichet in a public conference about this about 5 years ago. And I was really like the ugly fairy that gate crashes the baptism of the beautiful princess. This was just not a very polite question to put. So I think the ECB could have courted far more unpopularity and would still have had its independence. And then the actual question is regarding what the panel would do about the build-up of foreign currency lending to householders in Central and Eastern Europe. Some people seem to be under the impression that Hungary was not only going to join monetary union, but maybe was going to join the Swiss franc zone at some stage. That surely was an area where either the central bank or some consumer control organization, somebody should have stepped in. On the other hand, you could say that would be a form of moral hazard and the market should work. So I think it is actually quite a difficult question, but it clearly does have macroeconomic implications if you look at the potential drain on the Hungarian national reserves now as a result of the new legislation brought in by the government. So I'd just like the team to say to us what could have been done better there so we can learn for the future.
So, Maur Gudmundsson, Central Bank of Iceland. Now, my hybrid between a comment and a question is very much influenced by the small open economy thinking, because I come from a very small open economy. And it relates it relates first. So Maur Gudmundsson, Central Bank of Iceland. My comment question is very much based on my small open economy experience, as you can imagine. And this is probably, if in its message, is a question to Charles, but maybe the whole panel. Now, in the first instance, it relates to the separation principle. I think it was very neat and very clear, but maybe it was too neat. And I would like to take the example of forex intervention, because in a very small open economy where capital flows are influenced by the interest rate differential, and you can have these ebbs and flows of carry trade, forex intervention will both affect your conduct and monetary policy, but it will also have a financial stability role, because in a sense, when the capital flows in, you intervene, you build up reserves, and then that is a tool to deal with kind of the sudden stop, if you like. So how would you fit that into the separation principle? And then more generally, from the very small open economy standpoint, we don't only need a coordination between monetary policy and macroprudential, we also need a coordination between macroprudential and microprudential, because in a very small country sometimes both the micro and the macro is maybe 2 or 3 banks. So how do you see that?
Thanks so much. The micro-macro separation we'll leave for the next panel, okay? So you shouldn't answer it. You have got enough questions to answer. Let's try the regular.
Yeah, I'll just make one comment about Jacob's point. He unfortunately had to leave, but the point about information and data, I think, is absolutely critical. And I would encourage everyone in the room to help us to make sure that the right people have the right information. And that means not just within a country, but it also means the pooling of cross-border information, because it's the case, unfortunately, right now, that because of legal restrictions that exist within national borders, that some of the information that's collected for supervisory purposes that would be necessary to evaluate risks across borders is not available, and I think we have to work very, very hard to change that. And we're trying to work through mechanisms like the Financial Stability Board to make those adjustments. But I think there's a lot of work that's left that needs to be done. But on the basics, I agree with Jacob that the supervisory information that's collected needs to be, at the micro level, needs to be shared with the macroprudential authority in order for the macroprudential authority to do their job.
Capital inflows, which are then used to undertake foreign currency lending to domestic residents, has been one of the great banes of many countries, including your own, Mars, as you well know, and many others. Now, the problem here is that it's actually a fairly complex and risky exercise, unless, of course, the borrower has foreign currency receipts against which they can hedge the lending. Now, my sort of initial inclination would be just to ban it for those who don't have foreign currency receipts, but perhaps that goes too far and is a bit too interventionist. What I think I would do is I would say that any foreign currency borrowing involves a complicated balancing of risks. In order to do that, you need to be a really fairly well-informed investor. And I would require anyone who wants to take out a foreign currency loan to undertake an examination in probabilities of foreign currency movements, the effects that would occur if your exchange rate depreciated, and I would try and fail 98% of those who took that exam. In other words, I would only allow foreign currency borrowing either by those who had a natural hedge or by those who clearly understood the risks involved and were in a position to deal with those risks. And I don't think that there are terribly many of them. Very, very quickly, on the micro-prudential, I entirely agree with Jacob that I think it's essential for the macro-prudential authority to have access directly to information. But I don't think that that means that micro-prudential has to be put with the central bank. I see no reason at all why some additional use of resources so that the major systemically important financial intermediaries are not separately looked at, both by the macro authority and by the micro authority, seems to me to be a perfectly good use of resources. And after all, in the United States, the major banks are looked at by about 5 sets of regulators, state, different types of government, OCC, FDIC, FRB, SEC. The number of regulators are manifold, and it doesn't really matter. I think that you can overstate the importance of resource efficiency in trying to limit the number of people who go and look at your key financial intermediaries. And I think that there is an argument in terms of democratic deficiency of trying to put everything with the central bank. It does put the most enormous burden on the central bank governor, whoever that governor may be. I'm sure you can deal with it, Mars, but you're a relatively small economy. And if you're a relatively big economy, do you really want the central bank governor to have to do so many different kinds of jobs?
The question is not whether you want to. The question is who else could possibly do them. And that's more difficult to set up in different institutions. We have a setup, for example, where regulation and supervision for banks and non-bank financials with lending activity, especially leasing, is with a central bank. And then you have a securities market regulator and supervisor, a private pensions regulator and supervisor, and an insurance regulator and supervisor. And that works well, but I've seen other cases where the whole thing is under one roof. And I think there's an argument to be made for the latter. In terms of foreign currency regulation, we pretty much wrote the book on that one. It's quite interesting because we started with interest rate levels and then morphed into something else, and was a challenge of innovating ahead of markets while remaining consistent with your mission. The problem in Romania and in other countries was that the lending boom was fueled by unsustainable expectations of future income for households, based in the Romanian case on joining the European Union and on the fact that you would basically, because of the convergence in terms of real variables, would have a pickup in potential that I think was overestimated, and not just in Romania. Therefore, I think many countries underestimated the depth of their fiscal imbalances in structural terms. And that is another element of inconsistency, because if fiscal had been tighter, you would have had somewhat less appreciation pressure, and therefore less of an incentive to borrow in a majority way in foreign exchange. But I wouldn't necessarily add to the diversity of measures we used. I would stress again the fact that these were limited in their effectiveness because banks learned to innovate around them. When we had restrictions on bank lending, and many of them have been mentioned here, the normal recourse was to actually lend through leasing companies. When leasing companies were brought under the fold of the central bank, there was cross-border lending, or, more importantly, externalization of significant parts of local bank portfolios to the mothership. That led to more liquidity being present in the subsidiary, and therefore more of an incentive under the market share objective that they had to lend aggressively. They had a cherry picking of the portfolios that were being externalized, and therefore the average quality of balance sheets of the subsidiaries was worse than before. And then, of course, the whole thing reversed once Eastern Europe was seen as being risky, especially in 2009, so you had to take those loans back again. That wasn't as problematic. So going back to an earlier strand of argument, I think we made ourselves deeply unpopular by having restrictions on households in terms of DTI, debt to service to income, even without reference to foreign exchange. We had them because we knew that after 50 years of command economy of communism, there was a very limited ability for your average household to plan and manage significant amounts of debt over an entire business cycle, where the first cyclical recession we've ever had has been this one in 2008. Before, we had downturns that were transformationally induced. And that's quite important. No contest on the need to have coherence between micro and macroprudential, but that is part of a larger story, and it still has to be done by different teams of people. The level of division of labor within the Financial Stability Department of the National Bank of Romania is, again, quite important, I would think. Thank you.
Thanks. Just a few words reacting on David. As you have seen, you have followed the slides of the previous lectures, you've seen that Hungary is a real outlier. So our households are really indebted in foreign currency without gathering deposits in foreign currency. We are an outlier because in Romania and in most of the CESEE countries, they were indebted in euro. Our households got indebted in Swiss franc. And we are an outlier because we are a non-regulatory central bank, I think the last one in Europe. And there was no coordination between the regulator, the supervisor, and the central bank during accumulating the huge imbalance. We should live together for a while. Thanks for the panelists, thanks for the public. I think it was really a very vivid and interesting panel, and let's have the next one. Okay, then we will start with you, okay? Okay. Okay, Andreas, you like. Yeah, so far we were perfect with time. It was exactly 62 minutes, so the last panel will be 60 minutes because Peter should leave and our respectful governor should still give some final words in this situation. So for the last panel, we have in some sense, central bankers and regulators. Peter Pratt is the deputy governor, actually, of the European Central Bank, member of the, member of the executive board. For us, it's just the same as deputy governor. Okay, member of the executive board of the central bank. Earlier, used to be responsible for financial stability at the Belgian central bank, and he was the head of the bank supervisory committee beside the ECB, and we have been working together for a long. Jose Maria Roldan is actually the head of the financial supervisory part of the Spanish National Bank, if I'm right, and responsible for macro and micro supervision at all. And Andrzej Slavinsky is Director General of the Economic Institute of National Bank of Poland. There's a part in the middle between science and central banking. Our task for the last panel is the cooperation between host and home supervisors. We already tackled this problem in the previous panel. The big question is, can we control the contagion from the home country to the host country and vice versa? Because what we experienced during the crisis is there was a contagion from the home country to the host, and then it was a counter-contagion from the host to the home, and finally, both of them suffered. So can the cooperation between home and host improve? Do you see any better examples than we experienced during the fatal case in 2008, during the case of Fortis, which is a beloved case of Peter, when the cooperation really failed? Do you feel that this time the Dexia had a better result? Can we manage effectively the stability groups or the supervisory, over the cross-border supervisory groups? Can they get the information just in time, and can they effectively use it? And of course, the third, always the most important question, that who pay the final burden? Who is responsible for what? Which country is responsible for liquidity? Which one for the solvency problems? And can it be solved with a Europe with 27 different taxpayers? Peter, you are the first, and then that's turn.
Thank you, Julia. When I accepted to participate to this event, I was still at the National Bank of Belgium in the capacity you described. Now I changed job. I'm with ECB, the executive board, so it looks a little bit far away, the events you mentioned. It's also, I wanted to say, a learning process about the crisis. And with Jose Maria, as you know, and you, Julia, we have been in that environment since 2007 and closely together. And I must tell you that we are continuously reassessing our framework. And I listened to the comments before, and I can tell you, in my mind, some of the comments which were made, Charles, with all respect, look a little bit passé. You know, I think we talk about lending booms. We have to manage a terrible crisis today. And we think about how could we optimize organizations so that for the next crisis it will be much better. And it's a bit outside of our minds. So how we organize ourselves in the present environment, which is likely to last for quite a long period from now. So I wanted to say that. Now, if we go backwards a little bit, reversed, the question you address is how can we, address lending booms. I see lending booms and then the bust after. I think the first thing I would say is that we need a comprehensive approach, which is easy to say, but in the Basel Committee, where I had the honor to sit, we focus very much on banks, of course, and the balance sheet of banks with the capital, of course, saying the banks need more buffers, countercyclical buffers, of course, and more recently about maturity mismatch. So we had a big focus on the lending part of the financial sector. I would say immediately that we should focus as well to the borrower sides in the micro sense. That means the consumers, the households, and perhaps also non-financial firms, which have been, in most cases, very absent from all the framework. And then when you talk about the home and host cooperation, I think simply, I know it's going to be complicated anyway, so we can discuss all the frameworks, information exchange, and all that stuff. I look at the other side, and I say perhaps some of the products which are being sold to consumers should be forbidden, or should be, forbidden to some categories. And I remember years ago when I started the financial stability exercise, copying a little bit what the Bank of England was doing, I came very quickly with a message on housing prices, that housing prices might be too high, one has to be careful. I think that was in 2005. And I remember always there were strong reactions immediately. And 2011, nothing happened actually. So people say, you remember you were saying, housing prices may be too high, there is a bubble, and there are still indicators showing that housing prices are relatively high compared to a number of indicators, but as far it's still going on. And one of the reasons for that, and we don't know the future, of course, but one of the reasons is that there have been limitations about the mortgage products. I mean, and you know the difference between the US with the subprime market and other markets. So, of course, you can take it from the risk management part of the banks, but the banks are continuously going to tell you that they can manage these sort of risks, including the foreign currency loans. Because when you were talking to the lending banks in Hungary, in your country, you remember very well the story. We select, of course, the most resilient households with very strong cash flows and maybe international revenues, and these sort of stories we heard. And of course, you can take the other point and say this should simply not be provided. So what we did in Belgium many years ago was just simply to limit the variability of interest rates. Because we said if there is an interest rate shock, at some point, you get immediately a cash flow impact on the borrowers. And we say, okay, banks would have the possibility to have floating rates, but that would limit it in a range. And it will not be an immediate impact. These are things issues where I think we should put a little bit more focus today. As we know in the US, in a number of countries, new authorities are dealing with that. I think personally there are not enough part of this comprehensive framework. But I think we should also not forget this angle. The other angle I think which is missing, but which is which of course, is monetary policy and the credit cycle. This has been commented before, monetary policy and the credit cycle. Well, in the ECB monetary policy framework, as you know, this is present since the beginning. We have the Pillar 1, Pillar 2. I think we have a framework which allows to accommodate, or to incorporate very much that dimension. I know it's not very easy, but the idea is that there should be recognized weight, sufficiently weight to the second pillar, and in particular the credit cycle part in the monetary policy framework. So you get one, in my comprehensive approach, you get the balance sheet of the lenders, and I say a few things on that. You get the consumer, the borrowing parts. I mentioned the households, but I could discuss about the leverage of non-financial companies. You remember the post-Enron period, for example. You know the discussions about the tax incentives for debt compared to other instruments like equity, of course. And I mentioned the monetary policy framework. How do you coordinate all that is not an easy thing. I'm sure it should not be one authority. Obviously, these are different authorities. But I'm also sure that you need a framework of cooperation or even coordination to deal with these things. So that's my first general remark. So let me shoot very quickly. If we take the lender side, the balance sheet, and we have these counter-cyclical buffers. I know, Jose Maria, you're going to talk about that. It's very simple, the counter-cyclical buffers. In good times, you build buffer, it's always good. I'm not sure in bad times that you can use them. That's a big question that everybody knows today. If it's really systemic, because that's what you want to protect, it's not very sure that you can use these buffers in a counter-cyclical way. So it's not very sure. I hear things that if you increase in good times the cost of lending because you ask more capital, I draw your attention to the fact that at the same time when we discuss about more capital in the banks, a number of academics say it doesn't change the cost of finance because if you have more capital, the cost of funding is going to be lower, and so there is in the long run, no difference. So at the same time, we say that more buffers in the good times are going to increase the cost of lending. That's going to slow down your credit boom. But on the other hand, I see the same people saying that the cost of capital in a sort of Modigliani-Miller environment doesn't change fundamentally. I'm not saying who is right, who is wrong. I just say there is a lot of confusion. And the fact that if you have more buffer, I think it's difficult to use. In bad times, it's always good to have more buffers. And to hope that in good times, more capital requirements is going to do the job because of the cost of lending, I'm not sure when I listen to these different views. On the home and host, I think it was, and because I see the watch, I think for the home and host, we really have to focus on real estate. This is usually, you could say it's an easy job because we only talk about that part, real estate, and you have residential and you have commercial. And it's not so easy to deal. I mean, that will come back. I thought about the other sort of lending. I'm not so clear there. If you think of SMEs, for example, lending, I know sometimes they are confused with households and the smallest of the SMEs, so we have to take care of that. But for the commercial lending, I don't think there is such a big issue there. And I think the host has its responsibility. I think the cross-border problem is relatively limited. You know, if you want to make lending from outside of the country to SMEs, usually you have this adverse selection problem. You really get the lemons, and usually they are very careful, the banks, in doing that. For households, I admit it's different because there is this perception that you have collateral, and housing is always good collateral although now, you know, people have learned the lesson. So my point was the comprehensive assessment. What is the framework? I think the framework, we are building that framework in Europe with the ESRB. I think it's good to have it outside of the central bank, the ESRB framework. We insist very much. We insist, I draw your attention, to the extent that 4 of the executive board members of the ECB are not part of the ESRB. So we can observe if we want, but we are not part. And it's sometimes a bit frustrating. But on the other hand, it signals somewhere that you have your central banking function. You are well informed, you know, you are part of that discussion, but it's somewhere a little bit outside of the central bank. I think to some extent, I think it's good. And I think really you have the EBA framework. I think we are just starting. And I'm not saying it works very well yet. It's also normal because it's only starting. The problem, of course, is we do all these in a terrible crisis, which is, by definition, not easy. Thank you very much.
Thanks, Peter. You have a reaction on the previous panel as well. Jose, Spain used to be the example for the perfect counter-cyclical buffer accumulation in counter-cyclical provisioning. Was it really successful? How you estimate it? And what's your opinion about to evaluate it in a cross-border frame?
Thank you very much. Continuing with the issue of the credit cycle and the counter-cyclical capital buffers. But let me first of all thank the National Bank of Poland for the kind invitation today, and also the audience for staying with us so late in a Friday evening. If I were you, frankly speaking, I would not be here listening to myself. But here you are, so you will have to stand a little bit more. The Basel III framework has imposed a new policy measure that is very radical in design compared to what we had in the past, which is the countercyclical capital buffer. A countercyclical capital buffer is a macroprudential tool. It's a system-wide tool that is imposed on the whole of a banking system that can be triggered by the host authority, and that's a difference with other type of measures, and that can entail 2.5 percentage points higher core capital ratio for the whole of the banking system. This is very good news, and we have to stress that element. But having said down, I think that we also need to tame down a little bit the expectations on what the countercyclical capital buffer can do. What it can do, it's good to protect financial systems from credit busts. So when you have a credit cycle and things go south, it's pretty clear that the countercyclical capital buffer will help to protect the whole or your financial system, the integrity, financial stability, if you want, of your country. Probably it's not going to be good enough to stop the boom in credit. It will have some impact in slowing down the credit cycle, which may not be bad, but I think that in that environment, herd behavior among financial institutions is too strong for this type of measures to be effective in stopping the credit cycle. So good for financial stability, not so good for the credit cycle. Well, and here comes the third element. Most probably, it will not protect all the financial institutions from making mistakes during the boom. There's nothing better than a credit cycle to distinguish the good managers from the bad managers. The only problem is that it is extremely costly process to discover who is a good banker and who is a bad banker. Why do I know so much about what is going to happen with this tool, which is a new tool that has never been applied in any country? Well, as you were mentioning, Julia, we have a tool that is dynamic provisioning that is very similar to the countercyclical capital buffer. Countercyclical capital buffer is 2.5% of higher core capital in terms of risk-weighted assets. Dynamic provisioning was 1.3% of total assets. That's more or less equivalent. Both are equivalent in terms of size. Economically speaking, and I don't want to get into a debate of other types, but economically speaking, they are pretty equivalent.
in our experience, this is precisely what has happened. It was good, the measure, to protect the whole of the financial system. It was not so good in limiting the credit cycle. We don't know where we would have been without that. And clearly, it was not good in preventing some institutions to commit mistakes and now being, in the process of disappearing for the marketplace. So the countercyclical capital buffer is not a silver bullet, and we have to be realistic. We need to avoid overconfidence on this tool, and we need to use other tools, supervisory tools and economic policy tools to be able to stop a credit cycle. Let me now turn a little bit into the issue of the identification of credit booms. In order to have this measure put in place, you need to be able to identify an excessive credit boom. Here I have 2 comments. First of all, in a credit cycle that is accompanied by financial deepening in a catch-up economy, it is not sometimes so easy to distinguish which is the natural, healthy part and which is the excess. If you have home ownership, increases, this is even more the case. So, in practice, it's not easy to identify when I have to take away the plug, when I have to introduce the measure. Even more, I mean, the dangerous bit of the credit cycle is precisely the last part. So if you have to introduce this type of countercyclical measures, which in the case of the countercyclical capital buffer is discretionary, you have to take the decision to introduce that. If you start the debate between the supervisor and the central bank, between the supervisor and the central bank and the Ministry of Finance, with your banking industry, preparing the measure, well, if you debate for too long, the chances are that you are going to be late, and that is going to have consequences. So what is the lesson in terms of the identification of credit booms? It is far better to have an automatic tool. One of the advantages of dynamic provisioning compared to the countercyclical capital buffer is that it was automatic. You didn't need to discuss. It was introduced, it was linked to credit growth, and you didn't need to take the decision. That was an important element. With the tool that we have put in place, we need to make a discretionary decision. And, well, this is going to be a challenge going forward. Third comment, and I'm getting to the end line. The release of the buffers. I think that in general, we are paying too much attention to the building up of the buffers, and we are not paying enough attention to the release of the buffers. The release of the buffers are going to be a challenge. Peter, you were referring to that. If you are in a systemic situation, are you going to let your banks to run down the buffer? Who is going to take that decision? If we are talking about, let me now deviate a little bit, liquidity coverage ratio of Basel III, do you think that in the future, when a bank has a liquidity stress, the market will allow this bank to run down the liquidity coverage ratio without, going for the bank? I think that we have to pay more attention to the release of the buffers, and we really need to educate the market on that particular point. Let me finally mention the issue of home-host coordination. Frankly speaking, in this measure that is a system-wide measure and by definition is non-discriminatory, I cannot see any conflict between home and host. I cannot see any debate. It is different with institution-specific measures, because you always have the doubt, are there being, discriminatory? But for a measure that will affect all the financial institutions operating in a country, being, national banks, subsidiary of international banks, or branches through the reciprocity obligations that are imposed in Basel III, I don't see that this is going to be an issue. even less in the EU, and in a cross-border environment can be more complicated, but in the EU is even less. But the problem is that if we are saying that this measure may not be enough to stop a credit cycle, that means that you will need to impose additional measures. Additional measures that will not be through this, but through other type of macroprudential or microprudential measures. And in that context, you know, not in the countercyclical capital buffers, but in that context of additional measures that need to be taken, conflict may start, and that will be a different environment. With that, I think that I will stop and let the debate continue.
Thanks a lot. Andrei, if I'm well informed, you have some slides. Can it be produced? Okay. You are from a country where the home host issue is quite relevant, since a significant part of the Polish banking sector is owned by big European banking groups. So we are really very interested in your view. The starting slide is really exciting.
So what I would like to add to our discussion is the subject of autonomy of local supervisors. The main lesson from the recent crisis is that central banks need additional weapon to stabilize the economy and inflation, and this additional weapon should be macroprudential policy. In 2007 and 2008, also in Poland, foreign exchange loans were rising very rapidly. I was at the time in a monetary policy council, and we could do nothing because rising interest rate wasn't effective weapon to stop such kind of lending boom. So what are main point of my presentation? The first point is that the goal of macroprudential policy shouldn't be restricted to the systemic risk. It shouldn't be used only to contain a crisis, but also to stabilize economy. The second point is that central bank should play crucial role in deciding how to use macroprudential tools to stabilize economy, simply because central bank have experience in this field. Supervisors were focused on microprudential issues, and they simply do not have experience contrary to central bank. And what is necessary is also the sufficient scope of autonomy for local supervisors, because they know best about the conditions of different economies. And also Polish banks are important parts of European international banks. Basel III promotes minimum harmonization plus scope for autonomy of local supervisors. But I think that the notion of maximum harmonization may be a threat to financial stability, especially in host countries. The case for active macroprudential policy, when we focus on systemic risk, our target is to preserve solvency of banks, and we are using macroprudential tools in a rather passive way. If we include to the targets of central banks macroeconomic stability, the goals of macroprudential policy and monetary policy are in fact the same, stabilization of output gap, but it needs active use of prudential tools. From time to time, it may be costly for banks, but it would be beneficial for the stability of the banking system and for the economy. Because if we restrict the targets of macroprudential policy to the systemic risk, in fact we are hedging only against the systemic tools. So excessive focus on systemic risk is like a branch line of macroprudential policy. Because not only banking crisis can be externality of unstable lending boom. It is also balance of payments deficit, inflation pressures. So, and these externalities appear much earlier than the risk of a banking crisis. So it is a reason why we should use macroprudential policy not only to sustain systemic risk. And we should use different tools, not only capital buffers, but also liquidity ratio, LTV ratios. Yes, and what are the prospects for using macroprudential policy in such a way? At the moment, the Basel III is focusing mainly on microprudential goals, but what is needed? The first thing which is needed is discretion in setting different prudential instruments like capital ratio, liquidity requirements, and LTVs or margin for banks. But what is needed for us is full autonomy of banks' subsidiaries in host countries. It was the case, but under maximum harmonization, it may not be the case. And central banks would lose this important and effective instrument for stabilizing domestic economy and domestic banking system. What are the risks? So the first risk is that central banks wouldn't be able to use macroprudential tools to contain unstable lending booms. Also, effectively, autonomy of monetary policy would be impaired once maximum harmonization were implemented. Taxpayers in host countries could pay the costs for losses which would be caused in home countries. Banks in host countries might not be able to maintain proper liquidity cushions. And in fact, it would be further liberalization of short-term capital flows, which turn out to be the most dangerous form of short-term capital flows. Thank you very much.
Thank you very much. I think it's clear that there is again a quite nice division between members of the panel, and I would like to get back to it with a direct question. It's rules versus discretion. Rules, if you use rules, then it's much simpler, both in time and in space. In time, it means if it's automatic, you can decrease buffer as you increased it. If there is some discretion, it sort of becomes the question that when and how. In space is the direct line between the eastern part and, sorry, the western part of the panel, me, again, belonging to the eastern part, because we see that the level playing field, the unique European single rule book, will mean that the discretionary involvement of the host countries will be left aside, and all the information what is gathered locally will be lost. So the question to the panel, rules versus discretion, and what's your reasoning? And I would like add the second question, one of my first questions, contagion. How can you stop contagion except of increase, build again the capital control? That's the only possibility, but we wouldn't like to use it yet.
Me to start. You forget the third one it's rules. I mean, that's the regulatory framework. What you say, discretion is the supervision. And we heard in the previous panel that rules were somewhere there, but not implemented. So you need both. And the third pillar, and you know about that, is the crisis resolution framework, of course, the end game, Charles, the end game. So you need to find a proper not balance, but you need the three. And it is clear that we tried on the rules. We had very often weak supervisors, and this is really a strong reflection. Why is that so? That supervisors that identified very often problems were incapable of implementing these things. So this is a lesson we saw very often when we talk about the past, about, many things were seen also at the macroprudential level about the liquidity, abundance of liquidity before 2007, the crisis. Many things were identified, as well as the micro as the macro level. So the implementation story is a key question. Then we have to go into governance of, the people that take, that have to implement the rules that you have. You can have very good rules and very poor supervisors, as you know. You can have bad rules and good supervisors. You can all the combinations you have. What proves very difficult in a crisis, because it's very difficult to do in bad times, is the resolution framework. Because the resolution framework, all the discussions about the bail-in as a disciplining device for the good times, as you know, as long as you're in the bad times, it's very difficult to come with bail-in stories and all that, because you are going to exacerbate the problem in the bad times. And when the crisis started 2007, then when the recovery came in 2000, let's say 9, then the discussions about the bail-in, more discipline in the system came up, but the crisis was not yet finished. The fire was still there, a number of imbalances were still there, and so it exacerbated at some points the whole environment again. So we'll see how we get out, but we know exactly that we have to act on the three fronts there. Your question on contagion is a question of system design, which is a very, very difficult question. When you talk about contagion, I mean, in your mind, you talk about network design. You seek like an engineer or a biologist. You look at the system as a whole. You think about firewalls, of course, and you think about common exposures. You think about other institutions, important institutions that make bets that systemic risk would not materialize. If I have a bank only with AAA portfolio, AAA, even if the AAA proved to be real AAA, which was not the case, of course. But even if they are AAAs, would I be a safe bank? I would be a safe bank in whatever, 99 point something of the time. But what if I go in the bad state of the nature? So what we have seen is banks thinking they were extremely conservative, having very strong portfolio, for example, of sovereigns,
And they say, well, look, very good, of course, in capital requirement on risk-weighted basis. But actually what they were doing is making a bet that systemic risk would not materialize. The systemic risk is what you see a little bit today, that a big sovereign or sovereign risk would be something that would be almost unthinkable. And so you saw it's identifying all the situations where you think that a balance sheet would be very strong, but actually you would see that that balance sheet actually made some bets on the non-materialization of a systemic risk, which would be the case with a AAA portfolio. Even it would be a real AAA portfolio. I mean, if it's not, then it's really what happened actually. So when you talk about firewalls, I have to admit that the home host story is a real one, because if you want to put firewall, given the fact that there is no fiscal solidarity, you know, most often between authorities. So, I mean, this is something one has to recognize, and that's also the experience of the crisis. We also have to see the contagion between, you know, investment bank and commercial bank. So if you want to to limit contagion, you have to deal with system design, and you have to put firewalls. It's not necessarily leading to the most efficient system in a given state of the nature. For example, in good times, this environment, this redesign would be probably very bad in terms of efficiency, because you have firewalls, and that would limit the flow of funds, you know, between different activities in the market. In the bad state of the nature, of course, that would be a plus. But of course, that's very difficult to find the optimum there, of course. And that's what we are working, but this is really a long-term and uncharted territory.
On the issue of rules versus discretion, being Director General of Banking Regulation, I think that would be very strange if I'm not for the rules part of the debate. But having said that, and having a personal inclination for rules on everything, probably including on fiscal policy, I think that I have to admit, like Peter is saying, that the regulation without supervision is useless, and we have seen that in many occasions during this crisis. So you need supervision as well, and you need discretion. We need both. But at the very least, let me say that strong rules, it's a precondition for financial stability to be ensured. On the issue of the single rule book, let me try to explain what is my feeling. My heart is divided. I was chairman of the Committee of European Bank Supervisors, so I understand, you know, what is being tried by the idea of the single rule book. The old model is you have the directive, and each of our countries, we have our own interpretation of the directive. That meant that we didn't have a single rule book. We have a rule book for each of the member states, and that was the reality. That is messy. That is not helping the single financial market and this process of political and economic integration that we are in. So in that aspect of the single rule book, I understand that this is an aspiration. Having said that, to have on precise aspects of the directive, to be able to gold plate, not in the sense of the nitty-gritty details that makes it impossible to know what is the rule that is being applied on a country, but in transparent and specific issues. I think that in Spain, as a country, we are supporting the idea of being able to go beyond the directive in a transparent and non-discriminatory manner. So I think that both targets can be achieved, but not without a complex political discussion. So, well, let's hope that over the debate that we are going to have on CRD4, we are able to find this balance between the idea of having a single rule book in the sense of not having, you know, a different Basel III in each of the member states, and at the same time recognizing, you know, that authorities need to have some leeways in case something happens in their countries that is different from what is happening in other parts of the European Union. On contagion, I have nothing to say. I think that one of the good things about the debate on macroprudential tools is that these days I see a lot of capital controls that are sold as macroprudential instruments, which may be good for you know, marketing purposes. So If you do a capital control, don't call it that. Call it a macroprudential tool, and it will look better.
As far as cooperation between our supervisory authority and banks in home countries during the crisis, it was excellent that Polish supervisory authority asked international banks to raise the capital adequacy ratio, and they did it. Polish supervisory authority asked international bank to observe some liquidity ratios which were imposed by the Polish supervisory authority. So the gist of what I want to say is that international banks were listening to the expertise of the local supervisors, and the final result was excellent. Okay, because during the crisis, our banking system wasn't harmed in any way. Of course, there was some liquidity crisis, yes, but in fact, it was not liquidity crisis, but asset freeze along international capital groups. So my question is, why to change the system which worked in a successful way? Why not to use the expertise of local supervisors who know best the situation in a given country? And the second issue is that subsidiaries of international banks in Poland are quite often important parts of these international capital groups. So why not to improve the former situation instead of imposing something which would be very risky for both sides, and the structural flow of this new system would be that the decisions will be taken not by those who would pay the potential cost. Thank you very much.
Thanks. I think there are more or less an agreement in the panel that good rules and local strong supervisors. We have still time for one question from the public, if there is any. One, only one, Peter. If not, that I think it's really a nice end with such a nice agreement to end the panel. Thanks for the panelists. Thanks for the organizers for this conference and inviting us. I think we should thank for the perfect timing just 2 days before the famous 23rd of October. I don't know how could you imagine it when you started to organize it conference, but something you should have known. And thanking for the panelists and for the public, I should give the floor to our host, who is eventually is at home, so he's actually the home host at the same time. To give the floor to Governor Balka. Thank you so much.